Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Phil Mackintosh, chief economist at Nasdaq, to discuss global COVID-19 cases are on the rise and interest rates could possibly be moving higher as well, and how this can impact stocks, bondholders, and stimulus debt repayment. Phil, it's great to have you with us. And the COVID-19 case counts are not encouraging.
Yeah, that winter second wave that everybody has been talking about looks like it's coming. So overnight, the Europeans had 80,000 new cases. The US is running at about 60,000 new cases. It's a pretty significant increase over the space of a 5 to 6 week period. And the hospitalizations are starting to pick up. The death rates in Europe are starting to pick up. So COVID is definitely still around and still just as contagious.
I also point out, too, I think this chart is really interesting, just how much we have underestimated the pub culture in the UK and in Europe. It's a little bit different here in the US.
Yeah, I mean, I think what's interesting is when you look at Europe's mask compliance and Europe's sort of, I guess, overall social distancing compliance, they don't seem to have had the stresses and freedoms that Americans have complained about. And yet they've seen this second wave accelerate really quickly. And it's like, where did it come from? But when you look at their cafe culture and you look at this data in UK pub spending, it looks like in September, pub spending got back to pre-COVID levels, which, given everything we know about COVID, it spreads when you're indoors, it spreads when you're drinking, it spreads when you're talking loudly. A pub is probably not the first place I'd want to be, and that's likely going to cause some of the spread. And cafe culture is not that much different. Maybe you're speaking a little less, but it's pretty fascinating to see. Maybe that's where some of the new COVID case spread has come from in Europe.
Yeah, you certainly don't see football, American football Sundays happening at the bar as much as in the past, that's for sure. We're not even close to where that 2019 spend was. But this is another thing that's really interesting. We've been talking about a low interest rate environment for so long, and the expectation is going to be low for at least the next 3.5 years, according to what Jay Powell has to say. But you think that we could see somewhat of interest rates going higher?
Well, the market's kind of telling us that. So this is looking at 30-year bonds, which are obviously going to mature in a very long time. This is not happening at the short end of the curve, but the fact is the 30-year bond yield is starting to go up, not down, as it had sort of earlier in 2020. It's turned around, and it's probably trying to price in the risk that over the space of 30 years, we are going to have a little bit more inflation than we've got right now. And if you want a real rate of return, rates might have to go up, not down. I mean, they can't really go down much. So when you look at where it's at right now, I mean, less than 2%, that's basically roughly in line with inflation for the whole next 30 years. And inflation right now is pretty low. So, and the Fed has just said that they're going to adjust their policies and try and encourage inflation to get above 2%. So owning a 30-year bond on a 1.7 yield, if inflation's above 2%, you're actually going backwards, not forward. So it's not that surprising, and it's probably the market showing that it's starting to think a little bit about inflation, maybe more than thinking a little bit about the total debt load and whether financing new bonds itself might be difficult, and so you might have to actually accept a higher interest rate just to get people to give you the money to finance the government deficit.
Now, next slide here, we're talking about the velocity of money. What does that mean?
Yeah, so when you think about all of this stimulus money, normally if you gave everybody double the income for a year, then no more production happened. The prices of goods would have to double to soak up all that money. What's happened with the stimulus is a lot of it's been saved. It's been used to pay down debt. We know that for a fact. And so although we've seen a huge increase in the supply of money, all this free money from the stimulus flooding the system, it's been saved. And so the velocity of it slowed down. So it hasn't led to inflation yet. But this is one of those things that everybody's going to be looking at in the future, because there is a lot of stimulus in the system. There's a lot of money still saved. If we get a vaccine and we start to see people getting out and spending, there could be a lot of demand side inflation pressure that comes in. We've already seen inflation pick up in some of the things that are being demanded, like groceries and cars and houses in the suburbs. So it's not like we can't imagine a future with more inflation. And this is one of the indicators that I think will be important to watch.
All right, so on our last slide here, taking a look at permanent layoffs implying a recession, that's what concerns me the most out of all the charts that we're looking at today, because you and I have been talking about this for a number of weeks. If we are going to, maybe not a full shutdown, but certainly have a halt in the economy coming into the winter months, some of these businesses have not already recovered. We're going to have a new batch that won't recover, and perhaps we're going to have companies right sizing in 2021. The employment situation is not that good.
Yeah, and this is even with people dropping out of the workforce as well. So there's a lot of people giving up on work. There's a lot of people who realize their unemployment is going to last for a lot longer time. And I guess that's one reason why we've seen that people saving a lot of the stimulus checks that they've got so far, which is good because it will help with that problem as things go forward. But this kind of rounds out everything we've been talking about, doesn't it? The reason that the government needs to keep doing stimulus, the reason the government at least needs to target the stimulus is for all these people that are out of work more permanently, mostly through no fault of their own. It's because the industry they're in is a high risk activity, and consumers, when they see the second wave spike, don't want to do the things that they used to love doing. And so those jobs aren't coming back in the short to medium term. We need the vaccine. Some of the producers are talking about a December approval, but then distribution is probably going to take another 3 to 9 months before everybody's got the vaccine. So it's a reasonably long road ahead, and that's why the Fed and a lot of people are saying we have to keep up with the stimulus, even though it runs the risk of inflation and a large amount of debt in the future.
All right, Phil, thanks for joining us on Trade Talks.
You're welcome, Jill.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.